In 1985, Japan was buying America. Rockefeller Center, Pebble Beach Golf Course, Columbia Pictures, prime Manhattan real estate, these weren't isolated deals, they were signals. Japan's economy had become so powerful that its companies were acquiring the most recognizable assets inside the United States, while outperforming American industries at the same time. Its GDP per capita was closing in on America's. Its companies were dominating global markets, and its trade surplus with the United States had reached tens of billions annually. But the most important detail wasn't what Japan was buying. It was what Japan was holding, hundreds of billions in US government debt. Japan wasn't just exporting to America, it was financing it. And within 10 years, that entire system collapsed, not because Japan failed, but because the rules changed. By the mid-1980s, the imbalance had become politically explosive. American manufacturers were losing ground fast. Toyota was taking market share from US automakers. Sony and Panasonic were overtaking American electronics firms. Japanese semiconductors were outcompeting domestic producers. Factories across the United States were shutting down, and in Washington, pressure was building for action, but tariffs would have triggered retaliation. Trade wars would have escalated unpredictably. So the United States chose a different path, one that didn't target products, it targeted currency. On September 22, 1985, finance ministers and central bank governors from 5 major economies met inside the Plaza Hotel in New York. The United States, Japan, West Germany, France, the United Kingdom. Behind closed doors, they signed an agreement that would later be known as the Plaza Accord. Its objective was precise: weaken the US dollar, strengthen the Japanese yen, and rebalance global trade. What sounds like a technical adjustment was actually a controlled shock to Japan's entire economic model. The mechanism was direct intervention. Central banks coordinated to sell US dollars on global markets and buy yen. This pushed the yen higher rapidly. Before the agreement, $1 bought around 240 yen. Within less than 2 years, that dropped to nearly 120. The yen had doubled in value, not over a decade, not through market evolution, but in under 18 months by policy design. For Japan, this was devastating. Its entire system depended on exports remaining cheap and competitive. Now, overnight, those exports became significantly more expensive. A Japanese car that sold for $10,000 in the US effectively became $20,000 in currency-adjusted terms. Not because the company changed anything, but because the exchange rate did. Demand weakened, margins compressed, growth slowed, and Japanese firms were forced into impossible decisions: absorb losses and protect market share, raise prices and lose competitiveness, or shift production outside Japan. None of these options preserved the model that had built Japan's rise. At the same time, something else was happening, less visible but equally important. As the yen strengthened, Japan's purchasing power abroad surged. Every dollar-denominated asset became cheaper for Japanese buyers, which explains what happened next. Japanese capital began flowing aggressively into foreign assets. U.S. real estate, U.S. companies, global investments. This wasn't irrational behavior. It was the direct consequence of a currency that had been artificially strengthened. When your currency doubles, your global reach expands with it. But inside Japan, the pressure was building. Exports, the engine of growth, were weakening, so policymakers intervened again. The Bank of Japan slashed interest rates aggressively. The goal was to replace lost external demand with domestic expansion, flood the system with liquidity, encourage borrowing, sustain growth, and it worked at first. Credit expanded rapidly. Money became cheap. And that money began flowing into assets. Stocks surged. Real estate accelerated even faster. Land prices in Tokyo began rising at levels disconnected from economic fundamentals. At the peak, estimates suggested that the land under the Imperial Palace alone was worth more than all the real estate in California. Banks amplified the effect. They lent against rising asset values. Those assets were then used as collateral for even more borrowing. A self-reinforcing loop formed. Higher prices enabled more credit pushed prices higher, corporations joined in. They leveraged inflated balance sheets to expand further, both domestically and internationally. Acquisitions increased, valuations stretched, risk accumulated beneath the surface. By the late 1980s, Japan wasn't just strong. It was leveraged, inflated, and increasingly fragile, all built on top of a currency shift that had started in a single meeting. If this is changing how you see Japan's rise and how quickly strength can turn into vulnerability, subscribe. Because what happened next didn't just collapse an economy. It locked an entire country into decades of stagnation. The boom didn't slow down, it accelerated. Between 1985 and 1989, Japan's stock market didn't just rise, it went vertical. The Nikkei surged from around 13,000 to nearly 39,000. A 3x increase in 4 years. Real estate moved even faster. Commercial land prices in Tokyo multiplied several times over. By the peak, estimates suggested that the land under the Imperial Palace alone was worth more than all real estate in California. Not metaphorically, on paper, banks turned this expansion into a system. Loans were issued against rising land values, then expanded as those values increased, which meant rising prices created borrowing capacity. Borrowing capacity pushed prices higher. Corporations scaled the same strategy. They borrowed against inflated assets and used that capital to acquire more assets. Land, equities, foreign holdings. Balance sheets expanded rapidly, but the underlying assumption was fragile. Prices would keep rising. And by 1989, Japan wasn't growing anymore. It was fully dependent on prices never falling. At the peak, the entire financial system had become collateral dependent. Banks were exposed to asset prices. Corporations were exposed to asset prices. Even lending itself depended on asset prices. There was no buffer left. The Bank of Japan saw the imbalance, not in consumer inflation but in asset inflation, so it acted. Interest rates were raised 5 times within roughly a year. Short-term rates nearly doubled. That decision didn't slow the system, it removed the only condition keeping it alive. The entire expansion had been built on cheap credit. Once borrowing became expensive, demand for assets weakened. And when demand weakened, prices stopped rising. That was the breaking point, because the system required constant price increases to remain stable. Once prices plateaued, collateral stopped expanding, new lending slowed. Leverage stopped compounding, then prices reversed. The Nikkei collapsed. From nearly 39,000 in 1989 to around 15,000 within 3 years, a loss of over 60%. Real estate followed. Urban land prices fell for years, eventually declining by roughly 70% from peak levels. And unlike stocks, they didn't recover. But the most critical failure wasn't visible in markets. It was inside bank balance sheets. Loans had been issued against assets at peak valuations. Now those assets were worth a fraction of their previous value, which meant the loans were no longer backed. Non-performing loans spread rapidly. Banks were no longer dealing with isolated defaults, they were facing systemic insolvency. At this point, Japan had one remaining decision: recognize the losses or hide them. A full reset would have required forcing banks to write down bad loans, allowing failed institutions to collapse, absorbing a severe but short recession. Instead, Japan chose preservation. Banks were supported. Losses were delayed. Balance sheets were not fully cleaned. This created a new system, banks that were technically insolvent but still operating. Zombie banks, and because banks continued lending, companies that should have failed remained active. Capital was no longer flowing to productive businesses. It was sustaining unproductive ones. To keep this system functioning, interest rates were pushed down again, toward zero, and held there. The collapse had already happened, but the consequences were being stretched across time. Growth didn't return, productivity slowed, debt remained. Japan had avoided a sudden crisis by locking itself into a permanent one. China has already sold roughly $500 billion in U.S. Treasuries, from a peak of $1.3 trillion in 2013 to around $800 billion today. Not in a crisis, not in a panic, but steadily year after year. China built those holdings the same way Japan did: run large trade surpluses with the United States, accumulate dollars, recycle those dollars into U.S. government debt. At its peak, China was America's largest foreign creditor, just like Japan once was. But unlike Japan, China is reducing exposure before it becomes leverage against it. Japan held dollars and got trapped. Its currency was forced higher, its exports were weakened. Its financial system absorbed the shock. And because it held so much U.S. debt, it had no clean exit. Selling would have damaged its own position. Holding made it vulnerable to policy shifts. China studied that sequence carefully and drew a precise conclusion: never allow dependence to become pressure. So instead of holding its position, China began unwinding it. Since 2013, it has reduced holdings by roughly 40%. At the same time, it has shifted reserves into other assets. Gold accumulation has accelerated. Trade agreements are increasingly settled in yuan. Dollar exposure is being reduced across multiple channels. This is not liquidation. It's insulation. Because the risk isn't just holding treasuries, the risk is needing them while the system itself becomes unstable. The United States must issue massive amounts of debt every year, over $2 trillion annually, to fund deficits and roll over existing obligations. That system depends on continuous demand. Historically, foreign buyers played a major role. China was one of them, Japan still is. But if large holders begin stepping back at the same time, the adjustment is mechanical. Fewer buyers write slower economic activity, but the most important pressure point is internal. The U.S. government must refinance its own debt at those higher rates, on a total debt load now exceeding $30 trillion. Interest payments have already crossed $1 trillion per year. If yields continue rising, that number increases further, which creates a feedback loop. Higher interest costs means more borrowing. More borrowing means more treasury issuance. More issuance means greater dependence on buyers. And if foreign buyers are reducing exposure during that cycle, the system tightens. This is the structural tension. China is reducing holdings. The US is increasing issuance. Both trends move in opposite directions. Japan didn't adjust before pressure arrived, it absorbed it. China is adjusting in advance, reducing exposure while conditions are still stable. So the question isn't whether China is selling. It's whether it has reduced enough before the system demands more buyers than are willing to step in. Because Japan believed its position made it secure, until the structure turned against it. China is acting before that point. If this changed how you see China's treasury selling and the system behind it, subscribe. Because the connection between what happened in 1985 and what's happening now isn't coincidence. It's the same structure, under different conditions. And this time, the outcome may not take 30 years to unfold.